Have you felt it? You know that weird, unsettling feeling in the market where everything just seems off? Prices for everything are shooting up, but at the same time, the economy feels like it's grinding to a halt. Yeah, this isn't your typical downturn. It's a much trickier, much stranger environment, and it calls for a totally different kind of investment playbook. Okay, let's get into it.
So this is the big question, right? This is really the heart of the matter. You see those high-flying tech stocks, the ones that have been the darlings of the market for a decade, and they're taking an absolute nosedive. So your first instinct, my first instinct, is probably, hey, they're on sale, time to buy the dip. But here's the thing. Behind the scenes, the institutional investors, the so-called smart money, they're doing the exact opposite. They are quietly selling. They see a trap that a lot of people are about to walk right into, and understanding why they're doing that is the absolute key to navigating what's coming next.
To really get what they're doing, we first have to understand the beast that they are so afraid of. It's a word you've probably heard buzzing around in the financial news lately, like a ghost from the economic past, and that word is stagflation.
Now the name itself, it's not super creative, but man, is it descriptive. It's literally a mashup of stagnant and inflation. And what you get is the worst of both worlds. You get an economy that isn't growing, which usually means more unemployment, combined with the value of your money just evaporating because prices are rising so fast. It's this toxic economic cocktail that literally baffled economists for the better part of a decade.
So why is everyone talking about this right now? Well, because the parallels between the 1970s, which was the last time we really had a bad bout of stagflation, and today are getting just a little too eerie for comfort. I mean, look at this. Back then, you had high inflation, which came right after a decade of easy money policies. And then boom, a sudden supply shock in oil prices. Sound familiar at all? Fast forward to today. We've got high inflation after our own decade of monetary stimulus, and it's all being compounded by these crazy global supply chain problems and huge shocks in energy prices. This is so important because back in the 70s, this exact environment completely broke the classic 60-40 stock and bond portfolio. Both assets went down together. The playbook stopped working. And the similarities today, they're just too troubling to ignore.
Okay, so this brings us to a really critical point, a huge difference in strategy. When faced with this kind of economic threat, a lot of individual investors fall into a very predictable and often very costly trap.
And on this surface, it makes total sense, right? I mean, for the last 10, 12 years, buying the dip on tech stocks has been a slam-dunk winning strategy. These are the companies that have driven the entire market. We know their names, we use their products every single day. So when you see their stock prices fall 20, 30, even 40%, it feels like this massive buying opportunity. It's a powerful, almost Pavlovian instinct that was trained into us by a bull market that rewarded that exact move time and time again.
But while the retail crowd is excitedly rushing in, the big institutions are quietly, methodically slipping out the back door. This quote right here from our source material says it all. They are systematically selling their high-growth, you could even say speculative tech stocks. And they aren't just selling to hold cash. No. They are moving that money somewhere very, very specific.
Just let that sink in for a second. This is not just a few hedge funds making a contrarian bet. We are talking about a massive strategic pivot by pension funds, university endowments, the largest money managers on the planet. They are actively selling the very same assets that tons of individual investors are getting excited about buying. This is no accident. It is a calculated defensive maneuver based on that stagflation threat we just talked about. So what is it about stagflation that makes these amazing growth stocks so vulnerable? Well, it's a perfect storm, really. First, their costs go up. Things like energy, raw materials, they all get more expensive, and that eats directly into their profit margins. Second, when the economy is stagnant, people and businesses spend less money. So that explosive revenue growth these companies need to justify their high stock prices, it just evaporates. And third, when fear takes over the market, money runs for the hills. It flees from anything that feels speculative and runs towards things that feel safe. All of this combines to create this nasty thing analysts call terminal margin compression, which is just a fancy way of saying their ability to make a profit gets squeezed from all sides until it just stops growing.
Okay, so if they're dumping tech stocks, where is all that money actually going? Well, they're not panicking. They're executing a well-rehearsed plan, a playbook designed for exactly this kind of scary environment, and it's called sector rotation. Think of sector rotation as the chess game of the stock market. It's not about trying to guess what one single stock is going to do tomorrow. It's about looking at the big picture, the entire economic cycle, and then moving your pieces, your capital, into the sectors that are most likely to do well, or at least survive, whatever's coming next. It's about being proactive, not reactive. It's how they protect trillions of dollars.
And this is basically how they do it.
It's a top-down process. They start way up high with a 30,000-foot view of the whole economy. Asking questions like, is the economy getting weaker? Are those recession indicators flashing red? Then, they zoom in a level to the different sectors, and they watch where the big money is flowing. They see what's leading and what's lagging. And only then, after they've picked the strong, defensive sectors, do they finally zoom all the way in to pick individual, healthy companies inside those sectors.
And let's be super clear about something here. The goal of this whole process isn't to try and sell at the absolute top and buy at the absolute bottom. I mean, that's a fool's errand. Nobody can do that consistently. The real goal here is risk management. It's about looking around, acknowledging the economic reality we're in, and making sure your portfolio is built to withstand the coming storm instead of being pointed directly into its path.
So where are they actually rotating all this capital? Let's take a look at these so-called defensive strongholds. Where does the smart money go to hide when it thinks a recession is coming? Well, the answers are surprisingly boring, but they are incredibly logical. First up, consumer staples. These are the things we buy over and over without even thinking about it. Toothpaste, soap, coffee, soda, toilet paper. When things get tight, you might put off buying a new iPhone or a new car, but you are still going to the grocery store. Specifically, what they're looking for here are what they call quality factor companies. Businesses with really strong brands that can raise prices without losing customers and that don't have a lot of debt.
Next on the list is healthcare, and the logic is just as simple and powerful. People don't choose when to get sick. You don't stop taking your blood pressure medicine just because GDP is down for a quarter. It is a fundamental, non-discretionary need. It's not a want. So this sector tends to be incredibly resilient no matter what the broader economy is doing.
The third classic safe haven is utilities. I mean, think about it. We all need to keep the lights on. We all need to heat our homes. When you're forced to cut your budget, the electric bill is one of the very last things you stop paying. And for big investors, that creates an incredibly predictable and stable stream of revenue. And in a world of high uncertainty, that kind of predictability is like gold.
Now, this last one is really interesting, and it's especially relevant to our stagflation scenario, and that's energy. See, in a normal recession, energy demand usually falls, but in a stagflation caused by a supply shock in energy, the very thing causing all the pain, high oil and gas prices, is what makes these companies profitable. So it stands to reason that the companies producing that oil and gas are actually going to benefit. They can thrive in this specific, painful environment, making them a really unique and powerful hedge when everything else is going down.
Okay, so there you have it. That is the institutional playbook. Play defense, rotate into safe, boring, resilient sectors. But, to be intellectually honest here, we have to acknowledge that this isn't the only way to think about investing during a downturn. There's another, completely different philosophy out there.
I mean, this whole macro top-down approach, it makes a ton of sense. But what if it makes you miss the forest for the trees? What if by focusing so much on the whole economy, you miss out on these incredible individual companies that are going to thrive no matter what the economic cycle is doing?
This quote right here, it just perfectly captures the spirit of this competing micro-philosophy. The idea is to basically ignore all the economic noise, forget about the Fed, forget interest rates, forget recession talk, and instead focus with this incredible laser-like intensity on just one thing, finding truly exceptional, game-changing companies. And this slide just lays out the difference perfectly. You've got the macro strategy, which is top-down. It reacts to the economy by rotating sectors, and its main goal is to preserve capital. Then you have the micro strategy. It's bottom-up. It ignores the economy and just focuses on finding those individual jewels. And its goal isn't just to survive. It's to find a 100-bagger, a stock that goes up 100 times. A completely different mindset.
And the argument for this approach, it's really compelling. The people who believe in this will tell you that a truly revolutionary company with a world-class management team just isn't going to be derailed by a 2-year recession. They believe these companies create their own demand with innovative products and that the best leaders are focused on a 10-year plan, not the latest inflation report. For them, a recession is just a blip, a temporary sail in a much, much longer journey to the moon. And that ultimately leaves us with the big question. Because there is no single right answer here, it really highlights the fundamental tension in all of investing. Do you follow the institutional playbook? Do you play defense, rotate to safer ground, and just try to weather the storm? Or do you put on the blinders, ignore all the macro noise, and go hunting for those rare, recession-proof jewels? The path you choose doesn't just define your strategy, it kind of reveals what kind of investor you truly are.